Hello again, and welcome to another edition of my monthly recap. This one is for July of 2023. Welcome to the last day of July. So, a lot that happened this month, a lot to get into. So, roll up our sleeves, get loose with it. Number one, jobs reports were mixed. Jobs reports this year have been crazy hot, but there's a little bit of a mixed bag of results this month, which was kind of interesting to see. A number of things to kind of dive into, which we will. Another thing we saw was significant progress being made on inflation. I'm actually a little bit worried about next month's inflation reports for July. So August reports are for July, only because we're replacing a cooler rating from a year ago. And when you look at inflation, since they're year-over-year numbers, as important as today's figures are, what's equally as important is the previous year's numbers, because we add one report, a report gets dropped off. Well, the report that's getting dropped off from a year ago in August for July is going to be a pretty mild and tame report. So it's entirely possible that you're going to start seeing some headlines about stubborn inflation and inflation sticking around. Honestly, that's not really the case. Once we get past next month, we're going to notice a number of hotter months that we're going to be replacing with cooler figures, and inflation should start to continue the trajectory. So I would consider probably a minor blip in the otherwise downward trend that is inflation right now. So, but significant improvement on inflation. We're going to be looking at some numbers there. Fed hiked rates by another 0.25%. That's important. What was equally as important was the guidance they gave after the fact. So we're going to take a look at some of Jerome Powell's comments and really kind of get into the weeds on that. Housing picked up steam. A number of different metrics broke all-time housing records. And then mortgage rates had a roller coaster of a ride. They started off the month about 6.875, increased all the way up to about 7.25, and then they dropped all the way down to about 7%. So a little bit of a roller coaster ride with regards to rates. That's for a primary residence, 780 FICO score, 5% down, single family residence, that kind of scenario. So let's get into it all. Starting with jobs. As I mentioned, jobs this year have been just crazy hot, and somewhat to the Fed's dismay. And the reason I say that is the Fed's not going to come out and say, hey, we want softer jobs reports, right? You're not going to hear the federal government say that. But all these Fed rate hikes that they've been doing have been with the intent of slowing down inflation. Well, the problem with jobs is if too many people get jobs, and if those jobs start paying you more and more money, you're going to have more money to spend. And if you have more money to spend, that's going to cause inflation to start increasing. So the government has been trying to cause a little bit of pain with these Fed rate hikes. It's been very intentional. And when they see these really crazy solid job numbers, it starts to give them a little bit more concern, like, well, we can keep hiking rates. We can keep hiking rates because they're trying to cause that pain. They don't want people to necessarily keep going and getting jobs and getting paid more and more money because they have more money to spend. Spending more money leads to inflation. Inflation is simply too much money chasing too few goods. That's all inflation really is. So we get two jobs reports, ADP and then Bureau of Labor Statistics, BLS jobs reports. So ADP came in at 497,000 job gains for June, which was more than double the 225,000 that were expected. So another just shockingly good number. And if BLS came in similarly, the stock market would have rallied, bond market would have taken it on the chin a little bit. But the BLS jobs report actually came in softer. It came in at 209,000. They were also expecting 225 for job gains. And not only that, but they also had 110,000 negative revisions to both April's and May's reports. So starting to notice a little bit of softening of numbers with regards to BLS. Now, looking deeper into these figures, we get job stayers and job changers. So those who change their jobs versus those who just stay on their jobs. Job stayers, those who actually stayed put, saw their income increase 6.4% year over year. That's a decrease from 6.6% in the previous report. So that's not to say people are, starting to lose money where they're working, but that pace of increase that they're seeing is starting to slow down. And that starts to make sense if you start to look at a, generally speaking, softer employment situation, a softer job situation, right? You have a little bit less leverage, so you can't negotiate as much of a price rise when it comes to negotiating your pay increase next time. Job changers, similarly, also saw a little bit of a decrease. Again, not a decrease necessarily, but a slowing of the increase of their job gains. So job changers saw their income increase 11.2% year over year. That was down from 12.1%. The previous report down from 13.2%. So that is steadily decreasing. It means that in jobs world that we're in, that jobs market is not as hot as it was because employers out there who are looking to recruit people don't have to pay them as much money to get them to take the jobs on. And those that are staying on their jobs, they're not seeing as much leverage to be able to negotiate higher pay raises because, again, just as a whole, things are quieting down a little bit. We also got job openings that came in at 9.8 million, which was down from 10.1 million from the prior report. Still a lot of job openings, but as we can generally see, the employment world is starting to soften a little bit. Things are starting to calm down. Some of that pain that the Fed was trying to cause is starting to be reflected. Still solid numbers, but things are starting to slow down, worth keeping an eye on. We also saw inflation, and I mentioned this at the beginning, and cooling very quickly. Inflation has been cooling very quickly. Again, I'm worried a little bit about next month's reports. I think we're going to get a blip on the radar. We're going to see, inflation is sticky. Don't worry so much. Again, it should be one report in the next three. We're set up after that for a run of very good, solid numbers as we're going to be replacing hotter numbers from a year ago. With inflation, there's a number of different indexes. There's actually like three that most people look at because you can't just have one inflation report. You have to have three. Consumer price index, that's my favorite. That is inflation as you and I, us consumers, feel inflation. There's also producer price index, PPI. Producer price index is inflation as businesses feel it. So on the wholesale level. Now, the idea between these two is PPI tends to be a leading indicator for CPI. The logic is if businesses are feeling less inflation, if they're not feeling an increase in the cost of their goods when they're acquiring wholesale, they repackage them, they resell them, right? Well, if they're not seeing as much of a price increase there, they're going to be able to pass along that savings to consumers. So today's PPI leads to tomorrow's, or a couple months from now, several quarters from now, CPI, right? Businesses get charged less money. Great, they can pass that savings along to their customers. So consumer price index decreased from 4% to 3% in June. Crazy good. And this was once as high as 9.1%. The whole reason the Fed started hiking these rates was because inflation was showing up so high. Well, great news. I mean, it's now less than a third of what it was. PPI, even more shocking. It improved 0.9% year over year, down to 0.1%. 0.1% year over year. This was once as high as 11.7%. So businesses were getting charged more money. They started to charge that to consumers. Inflation increased. Now businesses are being charged less money. And the PPI is this orange line here. So you can see it's kind of a leading indicator. As this decreases, so does CPI tend to follow. So great news on inflation. Again, not so worried about the blip on the radar that we're going to have next month. When you hear those headlines, inflation is sticky, inflation is sticky, inflation is not cooling as much as it was before. Don't worry. I'm telling you right now, we're expecting that. It should be the month after that where we're going to start to see it cool again. So don't pay too much to the attention to the headlines when you see them in a few weeks here. All right. Well, the Fed literally just wrapped up their meeting last Wednesday. And as expected, they hiked rates another 0.25%. That was expected. Everybody was expecting it. It was very well broadcast. Everybody was very well aware. It had already been kind of baked in the markets as well, which is why we didn't see too much change to the bond markets or the stock market. Good news is there's only 3 meetings left this year, September 20th, November 1st, December 13th. So only 3 more meetings on the horizon. And there's going to be a little bit of a gap before the next one. So that's good news. The Fed did come out and say, hey, look, we're still worried about inflation. But again, CPI has decreased from 9.1% down to 3%. So decreased, they said, well, there was a really good report for June, but we're not going to weigh too much by one report. I'm like, it's not one report. It's been a number of reports in a row where we've seen this cooling of inflation. So to say one report, it's a little bit of a cop-out in my opinion. But whatever. Jerome Powell, seen here trying to calculate the square root of 3, I think. He acknowledged that monetary policy was restrictive and that progress has been made with regards to inflation and that the Fed can now afford to be patient. That one line is really, really good to see. It's them saying, like, look, we need to be more data dependent. And the good news is we have numerous reports due before we're going to get that next Fed meeting. We're going to have 2 updated inflation reports, 2 more business jobs reports on the horizon before they're going to meet next time. So they wanted to take a more patient approach. Well, great. They're going to get it. They're going to get a lot of data to base their next decision on. The hope is that maybe they're done with Fed rate hikes as a whole. Maybe they have one more in, the barrel. But we're going to see about that. The hope is that they are done. We shall see. Maybe it's one more hike for 0.25% sometime before the end of the year. If they're meeting at the end of next month, they would probably see that one Again, not so great inflation report next month and maybe decide to hike it again. Since they have 2 reports due beforehand, hopefully they take a more patient wait and see approach. The Fed did change one thing in their statement. It was pretty much copy and paste from the previous month, but they did update their economic growth from modest to moderate. And the reason they did that was because in GDP, second quarter GDP came in stronger. It came in at 2.4% versus the 1.8% that they were expecting for GDP. So they saw that and like, hey, great, jobs are still doing well. Businesses are still producing. So yeah, we'll upgrade that. And they're also no longer, and this is actually fascinating, they're no longer calling for a recession in 2023. The Fed's been trying this entire time to have a soft landing. They actually may ultimately pull it off. We shall see. But yeah, that second quarter GDP surprised to the upside, and that was good to see. Home prices are starting to accelerate. There's a number of different aggregators for home values to try to say, hey, look, how are values changing month over month, year over year? But these are the main 5. Case-Shiller, considered the gold standard, FHFA, Federal Housing Finance Agency, and then CoreLogic, Black Knight, Zillow. Those are all aggregators of information. Well, FHFA, Black Knight, and Zillow have all reported all-time high readings in real estate values this year. So that's really, really good. And if you look at the 2023 pace for each of these, very solid real estate appreciation. We are seeing a lack of inventory. It's less than half of what it was pre-pandemic. And normally, if you saw that little inventory, you'd see just a huge run on real estate. Everybody, multiple bidding wars, and we're seeing some of that, right? But we're not seeing as much as we should, given the lack of inventory. And the reason why is because of interest rates. Interest rates have certainly kept a lid on that. Mortgage rates are still amongst the highest level in almost 20 years. So when you're seeing higher interest rates, it's limiting how many people can actually enter that real estate market. If rates were at 5%, I think the competition would be crazy. Once again. So what I'm expecting to happen is eventually rates to come down. And as rates do, all those people that want to move but are kind of being held hostage by the really low interest rates, like, I want to move, but my rate is so good, I can't really afford to move. Fair enough, I totally get it, right? Well, when rates drop, those people are going to want to enter the market because we've just got a backlog of demand right now, queued up and ready to go. Once rates give a little bit of relief, those people are going to want to enter the market, list some houses. All of a sudden, we're going to have an influx of inventory, influx of buyers simultaneously, and it's going to be very competitive when that does happen. The question is when. A lot of experts thought it was going to be end of this year. Most people are now kind of pushing that out a little bit further. Hopefully, summer, spring next year, but all speculation at this point. We're not really sure when mortgage rates are going to start to improve. But yeah, nice to see real estate appreciating very positively, very well. FHFA, Black Knight, and Zillow all reporting record high home prices for real estate, which is great to see. So looking ahead, update inflation figures on August 10th and 11th. Again, CPI and PPI. We're going to get a break from Fed meetings. Whew, I'm more relieved than probably anybody on that. Give the Fed more time to get more information because they've been just trigger pulling on whatever's most recent information they have available to them, which has not been necessarily great. A little bit of a break from the Fed meetings. Only 3 meetings remaining for the year. Good news there as well. Markets should start to get back to basics a little bit. And then, like I said, won't there be a recession? Fed is no longer predicting a recession. And second quarter GDP came in stronger than expectations. So that was very positive to see. It's now questionable as whether or not there is going to be a recession in 2023. The Fed might actually have pulled off a soft landing as they were hoping. We shall see. And then jobs reports. We're going to get updated jobs reports on Friday. First Friday of every month, we get updated jobs reports. So that's what we're looking at for August. Looking forward to the markets getting a little bit back to basics now that the Fed is done talking for the time being. So hope that was helpful. Again, if you have any questions, if you have any feedback, please let us know. We're always looking to tweak things accordingly. We want to make sure it's useful for you and not a waste of your time. And then, as always, thank you so much for your referrals. It is the lifeblood of our business, and we do not take it for granted. I appreciate you all very, very much, and thank you so much. Talk to you later. Bye.